On this episode of What's Going On with Shipping, are ships turning around and heading back to Asia? I'm your host, Sal Mercogliano. Welcome to today's episode. So, I have seen this all over social media, on news shows, you name it. Are ships turning around, heading back to China? And the simple answer is no, they're not. I hope you enjoyed today's episode. No, I'm kidding. We need more details than that, and I'm going to give you more details. There's no way I'm doing a video that short. You should all know me by now. But if you're new to the channel, hey, take a moment, subscribe to the channel, and hit the bell so be alerted about new videos as they come out. Let's go over to marine traffic, our good buddies who track vessels worldwide, and you'll see there's quite a few vessels heading toward the United States as we speak. Green vessels there are cargo ships, largely container vessels, large swath of them coming across the Pacific right now. Red ones are tankers, but we definitely still see ships heading over to the United States. All right, let's break it down and take a look here because there is a lot to discuss. We've had just the number of changes in events has been pretty substantial here. So this is a most recent Bloomberg story over at G-Captain. Trump's tangled tariffs sow confusion as negotiators line up. So, after this weekend, everything's settled. President Trump has rescinded, at least temporarily halted, the massive tariffs across the board. What he has implemented is at least a 125% tariff, although I think it's up higher now, on China, and a 10% baseline on all other countries. Now, this move exempts more than $101 billion in imports from China alone. And what we're seeing is short-term wins for the tech champs, in particularly computers and phones. So there are certain areas that are not being included in the most recent leveling of tariffs. Then we have this this story over from Reuters. China's March exports jump in temporary boost as Trump 2.0 heaps pressure. So one of the things that we knew was going to happen was front loading. In other words, shippers and carriers were going to move cargo across in the first quarter before these tariffs went into effect. China's exports rose sharply in March after factories rushed out shipments before the latest U.S. tariffs went into effect. Exports rose 12.4% year on year, a 5-month high, handily beating 4.4% growth expected in a Reuters poll of economics. Exports grew 2.3% in January and February. So first quarter of the year, January through March, is typically a downward quarter, but not this year because what we're seeing is massive amounts of cargo heading across. All right, so let's look at some stories from Lloyd's List that goes into a bit more detail about this. This is Greg Miller's story. Trump capitulates on non-Chinese tariffs, adding to shipping uncertainty. So 3 main points he goes into. U.S. president abruptly rescinds reciprocal tariffs on non-Chinese trading partners. Again, it's at 10%, but jacks up Chinese tariffs to 125. North American import orders have fallen 20% week on week, according to Flexport, with declines expected to accelerate. Historically high Chinese tariffs are likely to put U.S. companies out of business and lead to some abandoned cargo at ports. So Greg is painting a pretty dire picture here of what is happening. Greg also follows this up. Buckle up. This is going to get real bumpy, according to the executive director at the Port of Los Angeles, Gene Soroka. He goes on here, March import volumes were strong due to front loading, while cargo already in transit will support April volume. So the April should be strong, but the numbers will begin to fall in May. Around 40% of U.S. containerized imports are from China. These cargoes now face an unprecedented 145%. So that's the final number we've seen it raised to. Then we get Shaixin Shen's report. Tariff relief fuels front loading, but China slowed down clouds peak season. Story, non-Chinese tariff reprieve could trigger a cargo rush to beat the July deadline. So we may see second quarter being as big as first quarter. Massive cancellation, suspension of Chinese orders will weigh on trans-Pacific vessel utilization. Duration of the U.S.-China standoff could depend on factors such as when U.S. inventories drained of Chinese goods compel a resolution. So when do you run out of your goods in your warehouses are going to have a major impact here. And then we have this story, and this is the one that really relates to the issue about ships turning around. Trans-Pacific blank sailing surge as U.S.-China trade war intensifies. Blank sailing. So a blank sailing is a scheduled sailing that does not take place. So shipping lines run ships on schedules. There are routes and schedules with ships sailing at appointed times, running a set schedule. So as blank sailing surges, carriers rapidly cut capacity on major trans-Pacific routes, driven by the tariffs and collapsing booking volumes. West Coast and East Coast trades hit and planned capacity from Asia to North America falling by up to 14% in recent weeks. Blank TEU volumes, those are 20-foot equivalent units, those are the short containers, has risen over six-fold. Carriers respond with short-term adjustments, avoiding permanent network changes for now, while smaller niche players face potential service closures amid deep uncertainty. So let's head over to Drewry's and take a look at two significant charts I think are really important to look at. First, this is the spot rates coming across from Shanghai over to four major ports: Rotterdam, LA, Genoa, and to New York. And what you're seeing here are the most recent kind of peaks coming back from the period of time, roughly about July and August of 2024. It begins to drop into October, comes back again in December, January. Now it's kind of risen and kind of flattening out, so that what we're seeing here right now is the Shanghai to New York rate is roughly around $4,000 a box. Shanghai to Genoa, about $3,500 a box. Shanghai to LA, that's down to roughly about $2,700. And then the Shanghai to Rotterdam is the lowest at about $2,300. Now, you may ask yourself, wait a minute, why is the Shanghai to Rotterdam the cheapest? It's actually the longest of those routes. Actually, the Shanghai to Genoa is the longest. But Shanghai to Rotterdam, which has to go around Africa because of the Houthi, is actually the cheapest because those are the largest ships. Those are the big ultra-large container vessels. These are ships over 18,000 TEU. So you get a economy of scale there. But it is the next chart that's really the most important, and this shows the blank sailings. So this chart breaks it down by shipping alliances. So Gemini Corporation, this is Hapag and Maersk. MSC, Mediterranean Shipping. The Ocean Alliance, this is CMA, CGM, Costco, and Evergreen. And then the Premier Alliance is basically everybody else. It's ONE, it's Yangmin, it's HMM. And what you see here is in yellow the amount of canceled sailings. Now, no one is over 20% canceled sailings, but in the key east-west trade lanes, the Trans-Pacific, the Transatlantic, and the Asia to North Europe and Med, 83 sailings have been canceled since week 16 out to week 20. So from basically about 14 April to 18 May, we've seen roughly 83 sailings out of a scheduled 713 sailings. That's a 12% cancellation rate. Drury is predicting that for the next 5 weeks, most east-west cancellations will hit the Trans-Pacific eastbound. That may hit as much as 53%, followed by the Asia to North Europe and Med, 29%, and then the Transatlantic westbound, about 18%. The frequency of sailings is expected to decline over the next 5 weeks, with our forecast indicating approximately 88% of weekly departures will happen on schedule. Gemini right now is expected to reach a strong performance rate of 99%. Gemini is the new cooperation between Maersk and Hapag. They are really touting the fact that they have been able to maintain their sailings. Now, blank sailings on the major east-west routes nearly doubled from 41 to 77 between weeks 16 and 19. This has led to a modest recovery in the rates. We're seeing the rates come up just a little bit. One of the reasons companies will blank sail is to artificially raise those rates. As capacity increases and volume begins to decrease, they need to offset that, especially in a very tight marketplace, by reducing the number of vessels that are available. Remember, we have excess ships. We're building more ships, new ships coming online, much larger ships coming online. To do that is they're going to start canceling these sailings, and that will start tightening the capacity out there. That will raise the rates. The other issue that's out there has to do with what we're forecasting in terms of the arrival of containers. This is over in Lloyd's list. They had this from the National Retail Federations, their global Port tracker. If you look at the 2023 numbers, 1.8 million containers in January, down to almost 1.5 in February, that traditional Q1 dip, then starts coming back up, head out into the summertime, and then rising all the way till just before the holiday season, and then the traditional decline. 2024, a bit different. We had a lot of factors going on in 2024, and not the least of which was the Red Sea and the Houthis. The question is, what does 2025 do? It is much higher. Look at that, 2.2 million in January, and even February, we're up at over 2 million. Question becomes, do we continue that uptick and that rise, or does it begin that precipitous fall? Remember that forecast for April has it dropping quite a bit. That is going to be a big question about the cargo coming out of China, the impact of 145% tariffs, but more importantly, is cargo coming from other areas? Again, 40% of all containers into the United States come from China. So any sort of impact here is going to be felt. Question is, does this mean a overall reduction in the yearly number of containers imported, or are we going to see a shift with containers now coming in from other places, Cambodia, Vietnam? So let's look at world economies. This is the chart of the top 20 economies in the world. The U.S. #1. It has grown in 10 years by 28% at $30.3 trillion, whereas China has grown from 11.2 to 19.5. They're at a 74% growth. The only country that's had a larger growth is India, but that is a fraction of what China has. Obviously, this impact on exports out of China and imports into the U.S. can be severe. How does this impact Chinese economy? Let's look at a little bit more detail here. So these are the world's biggest exporters. This is as of 2023. China, $3.38 billion. If you throw in Hong Kong, you're talking about almost $4 trillion worth of exports coming out of China and Hong Kong. U.S. substantial. You're talking the U.S. being the second largest exporter in the world with $2.02 trillion. If you look at importers, the U.S. is the largest importer in the world. This is where those tariffs are going to play a big role. We are the largest consumer of goods from around the world at $3.17 trillion. China is one of the largest importers behind the United States at $2.56 trillion. If you throw in Hong Kong, you're over $3 trillion. Actually, China is almost equal to the United States in terms of its imports. This is the chart that gets me the most. The needs of others. No other country buys more from China than the United States. Look at where most countries are. About 65 countries are less than 1%. South Korea is roughly 4%. Japan is just over 4%. Vietnam is about 4.5%. The United States is nearly 15%. In other words, we export 15% of what China exports. This is significant. If you impact Chinese exports with this, that is going to have a major impact. So what does this mean? Well, number one, ships are not turning around. What we are going to see, however, is a consolidation and a reduction in the number of ships sailing from Asia across the world. Now, this was going to happen anyway, but maybe not to the level we're seeing now. Because of overproduction of ships, particularly container ships, because of the potential of opening up the Red Sea, we were about to see this happen. However, what we're not seeing is ships turning around. That doesn't happen. I mean, that would be like an airliner turning around in flight and going back in because some people don't need to go to where they're going. Those cargoes are going to come into the United States. If they're on a boat, they're sailing. They're going to land in the United States. Now, maybe the shipper doesn't pick up the cargo or they reroute them back so they don't have to pay for the import fees and tariffs on them. But they're coming, or they'll have the cargo offloaded somewhere else. That's what's going to change. But I think that number from Drury is really the significant number. If these blank sailings continue to increase and we get over 20%, that's going to really have a factor. And then obviously, if the blank sailings increase, we can expect to see rates begin to creep back up again. I hope you enjoyed today's episode. If you did, hey, take a moment, subscribe to the channel and hit the bell so be alerted about new videos as they come out. Leave a comment, share it across social media, and if you can, support the page. How do you do that? You can hit the super thanks button down below or head on over to Patreon and become a monthly, yearly subscriber. Until our next episode, this is Sal, signing off.